So today, I want to talk about a new law that you guys should all be aware of, especially if you are into real estate. Now, there was a similar requirement that popped up last year, but that eventually did not materialize, and all of us were saved from additional reporting requirement. But this one is actually live. It did get passed, so we want to make sure that you guys understand it and and are compliant. As usual, if you want to get hold of me, just go to taxcodeadvisors.com. Yes, I do file taxes and I am taking on new clients. So just go to taxcodeadvisors.com. If you want to talk to me, set up a discovery call or just send me an email or message on a WhatsApp that we need to connect, and I'll be happy to reach out to you. So if you have been moving a real estate into an LLC, buying properties with cash, or doing any kind of creative financing deal, there's a brand new federal law that just went live and it has your name on it. Literally. As of March 1st, 2026, the federal government officially launched a nationwide reporting requirement that pulls back the curtain on who actually owns residential real estate when no bank is involved. So this is the difference. So if you guys remember last year, it was pretty much applicable to everyone, but this time it's a little bit different. So we are going to break it down exactly what this means for you. How does it affect you? What kind of penalties are there if you ignore it? And what can you do about it? This new law is called the Residential Real Estate Rule, issued by FinCEN. Now, those of you guys who don't know what FinCEN is, this is where you file your FBAR, your foreign reporting. The full form is the Financial Crimes Enforcement Network, which is a bureau of the U.S. Department of Treasury. Their job is to track financial crimes like money laundering, terrorism financing, that kind of things. So here's the problem. Residential real estate has been a go-to vehicle for hiding dirty money for decades. When a transaction goes through traditional bank, the bank's compliance team is already collecting and flagging suspicious activity. But when there is no bank involved, it's a black box. The government has no visibility into who was actually behind those deals. FinCEN tried to fix this last year with something called Geographic targeting orders, basically targeting reporting requirements in high-risk cities like Miami, New York, and Los Angeles. But those only applied in select markets above certain dollar threshold. However, this new rule that we are talking about brings all of that up. It is nationwide with no dollar minimum, and it is permanent. So the rule was originally supposed to kick in on December 1st, 2025. But FinCEN pushed the compliance date back to give industry professionals more time to prepare. That extension ran out on March 1st, 2026, and that's why this law is now applicable. You're going to hear a lot of people say this doesn't apply to them. Here's how to actually know whether it does or does not. The rule kicks in when all three conditions are met at the same time. Trigger number one. Residential property, 1 to 4 units. We're talking about single-family homes, townhomes, condos, co-ops, duplexes, triplexes, fourplexes, and yes, even vacant land where someone intends to build a residential structure. If the property has 5 or more units, it generally falls outside of this rule. Commercial real estate is also excluded. So if it's commercial real estate, don't worry about it. If more than 5 units, don't worry about it. Trigger number 2, no traditional bank financing. This one catches people off guard. If there is no mortgage from a regulated financial institution involved, it is considered a non-finance transfer. That includes all cash purchases, seller financing, subject to deals, private money loans, and even gift transfers where no money changes hands at all. Here's the critical detail. Even a private loan from a family member or a seller carrying paper can still be treated as non-financial under FinCEN definition because the lender isn't subject to anti-money laundering obligations the way the bank is. To make it simple, if bank is not involved, most likely this rule applies to you. Trigger number 3. An entity or trust receives the property. If the buyer or new owner in an LLC, corporation, partnership, trust, or any similar structure, this report applies. If property goes to a neutral person, just like a regular individual, no report is required. So practically speaking, if you are a real estate investor and you're doing what most real estate investors do, buying with cash, transferring properties into LLC, using creative financing, there's a good chance this rule applies to you. There is no price minimum. So sometimes, and this not with this, but even with many other things that people do, they think that, oh, it doesn't apply to me because it's only going to kick in to rich people. That's not the case. FinCEN has confirmed this directly in their publication. A $75,000 duplex in Midwest that gets transferred into an LLC with no bank involved is fully reportable. The rule doesn't care if your deal is $50,000 or a $5 million. So if you own a property, and I get a lot of people who want to move the properties into LLC, understand this. If you're doing that transaction, the rule does apply to you. So the report itself, called the real estate report, gets filed electronically through FinCEN, BSA e-filing system. It captures 4 main categories of information: property detail, address, legal description, basically everything you will be on your deed already. However, it also asks you more information about the receiving party. So name of the LLC, corporation, or trust that took title, its address and its EIN, beneficial ownership. Here's the part that matters most, actually. Anyone who owns 25% or more of the entity receiving the property, or anyone who has substantial control over it, must be disclosed. We're talking about full legal name, date of birth, home address, and yes, even the social security number. Signers, individuals who sign the closing documents on behalf of the entity, also needs to be identified. So, for example, if somebody sitting in China is buying a property here through some agent, then the US government now wants to know all the information about the agent, as well as who is the eventual beneficiary of that transaction. So it kind of, ties everybody together so they have a little bit more transparency. So now you may ask, well, then who actually files the report? Well, this is where it gets interesting. FinCEN built something called a reporting cascade. So it's not that simple. A 7-level hierarchy that determines which professional involved in the transaction is legally on the hook to file. I know, IRS never makes it easy. They always got to make things complicated. The cascade goes closing or settlement agent first, then the person who prepared the closing statement, then the person who recorded the deed with the county, then the title insurance underwriter, and so on down the list. The idea is that only one person files per transaction, but someone in that chain is always responsible. When is the deadline? Well, the report must be filed by the later of 30 calendar days after closing, or the last day of the month following the month of that closing occurred. And the reporting person must retain certain records, including, beneficiary ownership certification for 5 years. And if you guys remember, I talked about this subject matter last year in great details, BOI report. So it's kind of similar, but this one is really specifically for real estate. Now, the question you might ask is, well, is this information made public in that case? Because many of you guys actually set up LLCs to protect yourself, right? That's the whole reason. No. So FinCEN stores this data in a secured non-public database, the same framework used for Corporate Transparency Act. It is explicitly exempt from Freedom of Information Act request. Even other government agencies can't just pull this data. They need a subpoena or a court order to access it. That said, some people will still be uncomfortable with the federal government holding their personal information. I totally get that. That's a valid reason. And it is why understanding the strategy becomes more important. So let's talk about what happens if you don't comply, because this is where people need to take it seriously. So negligent violations, meaning you did not file and it wasn't intentional. That's why it's negligent. If it was intentional, then it would not be negligent. That can result in civil fines of around $94 per violation. If there is a pattern of negligent violations, that can escalate to an additional penalty of over, listen to this, $8,000. So pretty bad. Now, what about willful violations? Meaning you know about it and deliberately avoided filing. You filed with false information. That will carry criminal penalties of up to $250,000 in fines and up to 5 years in federal prison. On top of that, there are additional civil penalties that can be tied to full value of the transaction itself. So it becomes very risky. These aren't administrative slap on wrist fines. These are Bank Secrecy Act penalties. And FinCEN has made it explicitly clear that enforcement is their priority. So be careful, all of you guys who are, maybe you have a property in California, maybe, it's worth a couple of $1 million. So you say, hey, I'm going to take some money out of that property and I'm going to buy something in Texas or Midwest or elsewhere. And I'm just going to put it in an LLC and pay it using cash. Cash is fine, putting in LLC is fine, but forgetting to properly file the report is also a big issue. And by the way, this is why having a relationship with people you trust is so important, because you can reach out to them, talk to them. Hey, this is what I'm about to do. So they can remind you of some of these things. Many times I deal with people who come to me after the fact. They want to save a few dollars for setting up an LLC, but then that LLC is set up the wrong way, and they don't have a proper operating agreement. They don't understand how the partnership works. When they bring me their tax return, something they built on TurboTax, it doesn't have a balance sheet. The P&L doesn't match. The P&L and balance sheet doesn't match. Sometimes they are taking inappropriate deductions. All kind of compliance issues show up, but again, they all happen after the fact. So I certainly don't want you to be in that boat. If you need to get hold of me, yes, just go to taxcodeadvisors.com and reach out to me. Now, the question you're going to ask me, obviously, is, Deepak, are you saying we shouldn't set up an LLC? No, that's not what I'm saying. You should set up an LLC, especially if you have a lot of equity in a property. It is a great asset protection tool. This rule that I'm talking about does not prohibit putting property into an LLC. Okay, that's not the idea. It does not take away asset protection strategy. Those are just the way they were. It simply adds an additional reporting layer on top of certain transactions. If you own rental properties personally, your exposure is huge. A slip and fall, a contractor dispute, a tenant lawsuit, all of that can come directly after your personal assets. That is the whole reason LLC exists in the first place. That protection is still real, still legal, still worth having. The reporting requirement is inconvenience, and for some of you guys might feel like, extra cost associated with it. But the question you got to ask is, you get a personal liability protection by having an LLC. So I think that is still worth the headache. So let's talk a little bit about planning, because that is also important. FinCEN built in a number of exemptions to this rule. Some apply because receiving entity is already heavily regulated, such as banks, credit unions, maybe registered investment companies. Others apply based on nature of transfer, transfers due to death, divorce, court orders, or certain estate planning moves. But for average real estate investor, the most useful exemption involves a grantor trust. When you deed a property into a trust, you are both the person setting up a trust and the person making the transfer. That transaction can fall outside the reporting requirement. A transfer into a revocable living trust, your basic estate planning trust, generally is going to qualify for this exemption. The strategy a lot of investors are now using are, set up a grantor trust specific to that property, often called a land trust or a privacy trust. This is a simple structure tied to just one property. You are the guarantor, you fund it with the property, and obviously the exemption applies in this case. The LLC then holds the beneficiary interest rather than the LLC receiving the deed directly. The trust holds title and LLC is named as the beneficiary of that trust. You're getting the asset protection of the LLC without triggering the direct to LLC transfer that would require FinCEN reporting. Although this strategy doesn't work in all states. So different states have different rules and regulations around this land trust thing that I talked about. Then a lot of people like to set up LLCs in different states like Wyoming or Delaware. Wyoming is one of those few states that doesn't require public disclosure of LLC owners or managers at the state level. So between the trust structure at the federal level and Wyoming LLC at the state level, you kind of address both layers of security. You got the privacy as well as the asset protection. Now, one important thing, like I said, this trust-based approach is not one size fit all solution. So don't go try to do it on your own. It varies significantly depending on your state, how many properties you have, how your overall ownership structure is set up. Some states have specific statutory frameworks for land trust. Others rely on common law trust principle. FinCEN owns FAQ on this topic, so you can go read about it. Just go, search on website, just type in FinCEN and go take a look at some of the things. Now, are there going to be legal challenges like last year? There are active lawsuits challenging this rule already. So at least one major title insurance company filed a federal lawsuit arguing that FinCEN exceeded its authority under the Bank Secrecy Act and raised constitutional concern. As of now, those challenges have not succeeded in blocking this particular enforcement. That means the rule is live and being enforced. So don't play around with it right now. Maybe it goes away, but for now, it's active, it's live. So let me remind you guys. Identify which of your properties could trigger this rule. Residential property, 1 to 4 units, held in or being transferred into an entity without traditional financing. If you're using bank, you're good. Bank is already reporting that transaction. Know who is your responsible party. If you are using a title company or a closing agent, confirm they're aware of this rule and are prepared to file the report. If you're doing a direct deed transfer yourself, no title company is involved, understand that responsibility cascades to whoever recorded the deed. So if you're the one recorded the deed, most likely you're the person responsible. You can look into trust-based structures if privacy from federal reporting is important to your situation and you want to talk more about it. I'll strongly recommend that you set up a consultation. Let's understand the situation and then try to figure out what makes sense. And remember, the most important part here is the deadline. It's not like you have 6 months or a year. The deadline is 30 days post-closing or the end of the following month, whichever is later. So you don't have a whole lot of time. Let's just say 1 month at the most, right? So keep your records. Very important. For how long? Minimum 5 years. Beneficial ownership certification and any other designation agreements needs to be retained for minimum of 5 years. So keep that with you. So this rule is a major shift in how federal government oversees residential real estate, and it's going to catch a lot of investors off guard, especially the ones who have been quietly moving properties into LLC without thinking twice about it. The goal here isn't to scare you or, don't use LLC or something like that. LLC still works. Trust still works. Privacy planning still works. Tax planning still works. You just have to build it the right way. So keep your eyes open. And again, I always post all of this stuff on our YouTube channel as well as on our WhatsApp group. So if you're not part of that, then just reach out to me. I'll be happy to add. So that way, any updates that I have, I get to share that with you guys. Once again, guys, my name is Deepak. Thank you so much for spending your last 15, 20 minutes with me, and do subscribe to the channel, and I'll see you next time. Thank you.